Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome back to the deep dive. Our mission today is, it's very laser focused. We're pulling from a ton of research you shared with us about one of the biggest forces hitting businesses right now, and that's inflation.
Right.
And we really want to move past the big headline CPI numbers you hear about on the news.
Yeah, macro stuff.
Exactly. We're going to drill right down into the granular impact, the nitty-gritty, really specific effects of how rising costs literally rewire corporate finance from the inside out.
And that's such a crucial distinction to make, because when inflation spikes, and especially when it stays sticky, the finance team they're immediately on the hook.
They feel it first.
They feel it first and hardest. It's not just, a simple pressure on your margins. It's a systematic distortion of everything. Inflation messes with your long-term forecasts. It makes historical data almost useless. And it forces companies to fundamentally rethink these long-standing assumptions about growth, debt, and cash flow.
So that's our goal today. We're going to give you a strategic shortcut. We'll break down exactly where the cracks start to appear in the financial models, and maybe more importantly, what specific advanced strategies successful companies are using right now to get through this high-cost, high-uncertainty world.
We're talking planning, investing, capital allocation, the whole playbook.
Okay, so let's start with the basics. Inflation, at its core, is the broad increase in prices. But inside a business, it doesn't just show up as a single neat percentage, right? It's more like operational chaos.
That's a great way to put it.
So before we even get to the financial statements, what are the pain points that finance teams start hearing about first from, operations or supply chain?
Oh, it's a storm of moving pieces all hitting your cost base at the same time. You'll see raw materials and supplier prices rising, and often rising aggressively, way faster than the general CPI.
Right.
Then you have the wage pressures, labor costs are going up, especially for skilled workers. Then there's logistics, energy. Those spike and create immediate pain right in the supply chain.
And at the same time, your customers are getting squeezed.
That's the brutal counter effect. While all your costs are going up internally, your customers are becoming much more price sensitive. They're demanding more for less, so you're getting squeezed from both sides.
And that dual pressure, that's where the margin compression really kicks in. So if we pivot to the financial statements, where all the budgets and models live, this is where those old static assumptions just completely fall apart.
They absolutely break down.
Where do you see the biggest hits first?
Well, the first and most obvious one is your gross margin. It gets hit directly by a higher cost of goods sold, no question. Then your operating expenses start to balloon. That's from higher wages, rent, third-party services. But honestly, the biggest strategic headache is probably in working capital.
See, that's interesting because working capital management often feels tactical, But in an inflationary world, it becomes this strategic nightmare.
Exactly. All of a sudden, your inventory is significantly more expensive to hold. Why? Because the replacement cost is always rising, so you're tying up way more cash just for the same amount of goods.
You have to carry more value on the balance sheet just to stand still.
Precisely. And then finally, there's just the sheer volatility of it all. It makes budgeting and forecasting, which is, the absolute bedrock of the finance function, incredibly difficult. When inflation accelerates and your input prices are changing month to month, those old financial models that relied on historical stability, they just stop holding true.
So if that historical cost basis is constantly moving, can you give me a concrete example, like a data point that just completely falls apart when inflation really takes off?
Oh, absolutely. Think about standard cost accounting. Most businesses, they set a standard cost for inventory or for labor based on historical norms, right? Often for a whole quarter or maybe even a year.
Yep.
Well, when inflation hits, say, 10%, those standard costs are immediately obsolete, instantly. You might think you're making a 20% gross margin based on your old standard, but the second you have to buy the next batch of materials, that margin could just evaporate.
So finance is chasing phantom profits.
That's it. You're stuck trying to reconcile these profits on paper against a real cash flow that's getting worse. And that's why the focus has to shift to real-time variable costing. This systemic pressure is so powerful that it really forces 4 major strategic shifts in how corporate finance teams have to operate. I mean, these are changes that redefine the relationship between finance and the rest of the business.
Okay, let's unpack these. How does inflation change the strategy? Starting with, I guess, the immediate front line. Pricing. If your costs are going up every month, a yearly price review is just...
It's suicidal. That's the first shift. Price and strategy becomes ruthlessly dynamic. Companies just can't afford to rely on annual price lists anymore.
So finance has to step in.
Finance is pushed right to the forefront. They need to build detailed pricing corridors. They have to constantly analyze consumer elasticity scenarios, run real-time competitor benchmarks, all to guide sales decisions. We're talking about micro adjustments region by region, even down to the product size changing prices monthly, sometimes even weekly, just to protect your margin.
And of course, central banks react to inflation by raising interest rates, which hits the Treasury function directly. What's the second shift there?
The second shift is rising borrowing costs and active debt management. High inflation, it translates directly into higher interest rates. The cost of capital goes up.
So debt management is no longer a quarterly review.
It becomes a daily strategic task. Treasury teams have to actively revisit their entire capital structure. If they're holding a lot of floating rate, debt that adjusts with interest rates, they have to seriously consider the immense risk there and maybe shift that exposure over to fixed rate debt. You might pay a premium now, but you're buying certainty against future rate hikes.
That rising cost of capital has to have a huge ripple effect on what new investments get approved, right? It must filter out a lot of future plans.
Absolutely. And that is the third shift. Investment decisions get rigorously reprioritized. Think about long-term capital projects like a new factory or a complex IT system that might pay back over, say, 8 years.
Right.
Those become much, much harder to justify. The cost of capital is higher, and the projected cash flows 7 years from now are way less certain because of inflation. So the priority shifts, and it shifts decisively toward high-return, short payback projects.
Wait, I want to push back on that a little. Does that mean inflation is actively discouraging essential long-term stuff like maintenance, infrastructure upgrades, maybe even R&D that won't pay back for 5 or 7 years? Are we sacrificing future stability just for a quick return?
That is the core strategic risk. That's the dilemma. Finance now has to enforce much higher inflation-adjusted hurdle rates. A hurdle rate is just the minimum return a project needs to get the green light. So if inflation is at 7%, your hurdle rate needs to be significantly higher than it was when inflation was 2%. And that inevitably screens out some of those crucial long-term investments. The finance team becomes this internal judge of patience versus immediate payoff. It's a huge challenge.
Okay, and the fourth shift. This one seems like it affects every deal, every asset on the balance sheet. Valuations.
Correct. Fourth, valuations inevitably shift downward, and it creates this compounding negative effect. Inflation pressures two key parts of any valuation model, like a discounted cash flow analysis. First, it lowers your expected future cash flows in real terms.
Makes sense.
Second, and this is just as damaging, the increased risk and interest rates, they drastically increase the discount rate you use to calculate present value. So when you increase the number you're dividing by and decrease the number you're dividing, the present value just drops sharply. This hits M&A, shareholder value, even internal things like goodwill assessments.
Before we move on, let's just circle back to working capital. You called it a major strategic headache. We talked about inventory, but what about the collection and payment cycle? We're talking days sales outstanding, days payables outstanding.
Yes.
Why does that cycle become so dangerous all of a sudden?
It's all about the rapid erosion of currency value. It's like trying to hold sand in your hands, If your customers stretch out their payment cycle, if your days sales outstanding goes up by even 5 days, the cash you eventually collect is worth significantly less in real terms than it was on the day you made the sale.
And on the flip side?
On the flip side, finance teams have to look strategically at days payables outstanding, or DPO.
Yeah.
If inflation is high, every single day you can hold on to your cash and delay payment to suppliers. While keeping those relationships healthy, of course, is a day you maximize the real value of the cash you hold. Intense focus on those metrics becomes completely non-negotiable.
Okay, so understanding these shifts is one thing, but seeing them in action is always better. Let's look at the sophisticated moves that some real corporations made, starting with a consumer goods giant like Procter & Gamble.
P&G is a masterclass in strategic pricing. It goes way beyond just simple percentage hikes. They leverage their incredibly strong brand equity to manage how consumers perceived the changes.
How so?
Well, for example, instead of just a blanket 10% price increase on a bottle of Tide, they might choose to redesign the pack size. Reduce the unit count a little, but keep the shelf price the same. It's a very subtle form of what's called deflation management.
And they also push their higher-end products.
Crucially, yes. They elevated their premium tiers, the specialized pods or the super concentrated versions, making it easier for a consumer to trade up to a higher margin product. Their finance teams were key here, modeling pricing elasticity by region, by product line, to find that exact tipping point of consumer resistance. It was all about maximizing margin protection without losing too much volume.
That focus on segmentation, that shows up with other companies too. I'm thinking of McDonald's. They face huge hits from food, labor, energy costs, and often in markets where people are extremely price sensitive.
McDonald's had to adopt what you could call radical segmented pricing. In some high inflation regions, they were implementing dynamic adjustments, sometimes changing the prices on basic items every single week.
Wow.
But they strategically kept a fixed value position in their core, super competitive markets to protect their market share. And internally, this was all driven by an efficiency mandate from finance. Automate more tasks, optimize staffing, and constantly shift the menu mix towards higher margin items like beverages or certain premium sandwiches to keep the overall business profitable.
Then you have a company like Walmart, where their sheer scale gave them this unique, almost counterintuitive advantage.
Walmart's scale is their superpower. They used it to negotiate extremely aggressively with suppliers, often getting terms that other retailers just couldn't dream of. Their whole everyday low prices strategy became a massive competitive advantage when everyone else was forced to hike prices.
And they did something really interesting with their inventory.
Yes, this is the fascinating part of their finance strategy. Unlike most companies who were trying to shrink working capital, Walmart used its massive balance sheet to actually carry significantly higher inventory levels than normal.
Hold on, they intentionally stocked up. Wouldn't that just tie up cash and create risk?
It did, but it was a calculated inflationary hedge. By carrying deep inventory, especially on staple goods, they effectively locked in pre-inflation prices for longer. This acted as a buffer. It let them stabilize prices for consumers for a longer period, which drove traffic and stole market share from competitors whose own input costs were rising faster. It was a brilliant strategic use of their balance sheet.
And finally, let's look at a sector that just gets hammered by volatility, like airlines. Delta Airlines, for example, dealing with brutal hits from fuel and labor.
Delta's response had to be immediate and multifaceted. They used robust fuel hedging strategies, basically, locking in fuel prices months ahead of time. They used dynamic ticket pricing that adjusted based on real-time costs, not just how full the plane was.
And they managed capacity.
They became masters of it, quickly cutting rights where profitability just vanished because of a fuel spike. But the critical finance adaptation here was all about pace. Because of the extreme volatility, their finance teams moved from modeling fuel cost scenarios quarterly or even monthly to doing it weekly.
Weekly?
That radical increase in what you could call forecasting velocity let them make operational decisions way ahead of their slower rivals. All these examples, they really point to a set of concrete, actionable steps finance professionals have to take. It really all boils down to maximizing speed, visibility, and control over your costs and your capital.
Okay, let's frame this as a direct toolkit for you, our listener. What's the very first step to building forecasts that actually reflect this new reality?
First, you absolutely must build inflation sensitivity into your forecasts from the ground up. You can't rely on a single base case anymore. It's not good enough.
You need scenarios.
You need low, base, and high inflation scenarios, maybe even scenarios for specific inputs, to truly stress test your margins, estimate your working capital needs, and map out how you'll respond with pricing. Stress testing is it's non-negotiable now.
And we've seen how critical pricing is. So what's the tactical advice for finance teams to actually pull off that dynamic pricing model?
You have to strengthen pricing capabilities by integrating finance and sales. This isn't just a sales task anymore. Finance has to provide the data infrastructure to analyze elasticity continuously. You need to know not just if you can raise prices, but by how much and for which specific product before your sales volume falls off a cliff.
What about protecting the balance sheet? How do we shield borrowing costs from more rate hikes?
You have to reevaluate and potentially rebalance your capital structure. If you have a lot of floating rate debt exposure, the risk is just too high. You should seriously consider shifting to fixed rate debt to lock in some certainty, or at least aggressively look at interest rate hedging tools like swaps to mitigate that risk. It's a purely proactive move.
And for those big capital projects, how does finance enforce that discipline you mentioned?
Prioritize only high-return investments. Discipline is everything here. Only greenlight capital projects that can outperform those higher inflation-adjusted hurdle rates. And on top of that, you have to strongly favor projects with shorter payback periods. The shorter the time horizon, the less exposure you have to future uncertain inflation shocks.
And managing those day-to-day operating costs that just keep creeping up.
You need to improve cost visibility and control. That means breaking down your cost drivers into really granular components, not just materials, but copper, lithium, shipping from region A. Run sensitivity analysis on those specific line items to find your biggest risk areas before they become a full-blown crisis.
And I guess that leads to hedging.
Yes, and finally, strategic hedging is essential for anything highly volatile. Use hedges for commodities, energy, fuel, or foreign exchange exposure where it makes sense to guarantee some degree of certainty in your cost base.
That's a really comprehensive toolkit, but it feels like it needs one final element you mentioned earlier, communication speed.
Yeah.
The finance team has to be briefing leadership constantly.
Constantly. Sometimes weekly, like we saw with Delta. They have to be reporting on cost trends, emerging risks, and updated forecasts. In a period of high volatility, slow communication is basically strategy paralysis. Hashtag, outro. You know, if there's one single takeaway from our deep dive today, it's this. Inflation doesn't just raise prices, it fundamentally changes the rules of corporate finance.
It's a paradigm shift.
It is. It demands immediate, aggressive adaptations in your models and your core assumptions, and critically, in the very pace of your decision-making. Certainty is out, flexibility and speed are in.
So we covered how inflation drives up uncertainty and costs, how it forces companies into these dynamic strategies for pricing and capital, and the absolute importance of hedging and scenario planning.
The world we're all operating in now just requires a speed of planning that would have been seen as complete overkill just a few years ago.
And that leads us to our final provocative thought for you to chew on. If managing something as volatile as fuel costs forces a company like Delta to move to weekly scenario planning, what other long-established quarterly or even annual reporting and budgeting cycles in your own business are now dangerously outdated?
That's a great question.
Think beyond just the numbers and consider the necessary forecasting velocity you need to make sure your business stays strategic instead of just perpetually reacting to rising costs in this new world.
Until next time, stay sharp, stay strategic, and keep leading in finance.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.